Good evening and welcome to the Money Show, your one-stop destination for everything that matters to your money. I'm Kavita Thapliyal, and whether you are saving, investing, borrowing or spending, we bring you the smartest conversations, expert insights and actionable advice to help you make the most of every rupee. And today we decode the financial choices that affect your daily life, and from insurance to taxes to mutual funds, credit scores and retirement planning, because in a world full of noise, you deserve clarity, and that's exactly what we deliver every single day. So whether you're a first-time investor or a seasoned planner, a young earner or someone eyeing financial freedom, the Money Show is here to help you take control of your money and your future. So just in case you're watching the show live and need any guidance from us or even anything about your financial goal, a strategy maybe, you can send across your questions on our WhatsApp number, which is 8657974571. We also have an email ID where you can send across your questions, themoneyshow@etnow.de. Okay, so let's begin the show. And today's young investor, they are confident, they are digital savvy and not afraid of taking risk. But here's the big question that we are asking on the show today. Are they taking informed risk, or are they simply chasing trends and FOMO-fueled hype? From stocks to crypto to startup investing, the new age investor is experimenting like never before. But do they truly understand what they are getting into? Are they thinking long-term wealth creation or just short-term returns? To break this down, we are joined by someone who has been at the forefront of making investing simple, accessible and relatable, especially for the younger generation. Let's welcome Pratik Oswal, Head of Passive Funds at Motilal Oswal AMC, and we'll talk about the most common mistakes young investors usually make, what drives the decision today, logic or social media, and how they can truly build wealth with discipline, not just excitement. Pratik, good evening and welcome to the show. Let's begin with the first question. What's your take on these youngsters, and their understanding of risk in their investment these days? Is it really driven by social media? Do they even understand, or they are willing to take that risk, even despite knowing that this is going to be a risky investment option for them?
Yeah, I think definitely the awareness for looking at risk has gone up considerably over the last few years. I think if you look at India, most people were driven by returns and still are. If you look at, the mutual fund trends over the last 3 to 4 years' time, you'll see that the highest flows tend to come to mutual funds with the highest return. And I think that that sort of argument is certainly changing with continued SIPs happening in the markets. So definitely, I think there is a conversation on risk happening in a very big way. But however, I do feel that it's still lacking for majority of the investors that we speak to today. So I'll give you an example. When suppose you're in the US and you talk about a fund that is giving you returns of say 20-25% plus, the second question that an average person would ask is, at what risk? Today I think 20-25% is somewhat which is given. So I do feel like, that terms like Sharpe ratio, drawdowns, risk-adjusted returns, we're still in a very early stages of adoption of these models. But I do think that, people do understand risk from the perspective that investing in small caps is riskier than investing in mid caps, which is riskier than investing in large caps. So I think the broad parameters are there. It's just that, people don't see it from a different lens.
So, Pratik, now since you're heading passives, and you've got quite a hold over there in that domain, we've seen surge in passive investing among younger demographics. Now, do you think this is a sign of risk aversion or smart delegation? How will you look at this trend?
Yeah, so passive funds have definitely grown in shape and size, and today most portfolios that we end up seeing tends to have some passive fund in that portfolio. So I think people have taken the call of having an allocation towards both active and passive, which is in line to what we've seen globally. We believe that I think adoption of passive funds is not to do with anything to do with risk reduction, but actually removing complexity. We believe that investors today, especially investors who are coming in directly and buying mutual funds, really want a very easy to understand, no frills, long-term product, which is what passive funds offer. They can expect low cost, they can expect very good long-term returns, and they're also very easy to understand and easy to hold for many years because they don't have to worry about performance. I think in terms of risks, in fact, we believe that passive funds, there are a lot of categories called, say, smart beta funds, where you have momentum, which is quite risky. You have small cap indices. You have international funds. So there are obviously a lot of passive funds that can also offer investors access to risky products. But we believe that it's more of the sort of simplicity, and it's more outsourced complexity is what people are trying to do when they're adopting passive funds in their portfolio.
Uh, let's talk about balancing their investment strategies as per time horizons. And let's just focus on short term because that's where the hype is. Okay, Pratik. How do you see young investors balancing short term hype over here?
Yeah, so I think the I mean, especially young investors, they're I think the biggest challenge, with young investors is getting their expectations right. Most investors we speak to are, relatively young, say early 20s or even late 20s, have, we believe, very high expectations from the markets. And the reason why this high expectations is because they've seen incredible, most of these investors have come in post-COVID, where the markets have delivered, say, 20-25% plus CAGR. So, we've sort of got into a phase. If you look at India today, we only had 4 crore demat account holders pre-COVID. Today we have 18 to 20 crore demat account holders. So, the market has grown considerably, and most of this market has got used to very high returns. So I think getting young investors to lower their expectations towards more long-term trends, which is, say, in between 10 to 15%, is the hardest part. The second, and which is why we believe that as asset management companies, the focus on long-term returns, the focus on long-term stability is, I think, a lot more important. The second thing is this, how do you balance short term versus long term? We believe that, investors are increasingly becoming very short term, which is not a very good trend. If you look at the average mutual fund holding today, it's about year and a half, which is abysmally low. Ideally, if you're looking at equity funds, investors should look at it from a 5 to 7 year minimum. So we believe that there is a lot of churning happening in portfolios. People are using mutual funds to trade, all which is not good for long-term wealth creation, which is, I think, the probably the only or the most defined way of creating wealth over the long term. And I think asset classes like crypto, which obviously have done extremely well, come with a lot of short-term volatility, and so we believe that the best way to tackle this is through asset allocation, and is to make sure that So when I talk to investors today, and also what most AMCs also have gone to the approach of, it's very hard to say no. It's very hard to say no, that don't do this, don't do that, don't do options, don't do crypto. But what we tell investors is that, if you have a portfolio of, say, 10 lakh rupees, you can probably allocate, say, 80-85% of that towards long-term mutual funds, very simple stuff. And then the balance is what you can put into asset classes like crypto, or if you want FNO or single stock or whatever it is. I think what that enables is that you're essentially making sure that 80-85% of your portfolio is growing at a very good rate, at a rate in which you'll create wealth. And also, you're also getting exposure to those short-term segments, which you're really passionate about, or which you can try out. And if it works out, you can always expand that later. I think this has really worked very well for a lot of our younger investors who are interested in, exploring the different risk asset classes, and who wanna, are in that for the short-term return.
That's very well explained by you, Pratik. But then I also want to understand, certain concepts or basic concept of financial planning which investors of every age need to really incorporate. So are you seeing young investors incorporate concepts like diversification, asset allocation, or rebalancing, or even international exposure in the portfolio? What do you think, and how do you think their approach is towards all these formats of understanding?
Yeah, so it's a very, I would say that wherever younger investors who have a larger portfolio, say 10 to 50 lakh type of a portfolio, we have increasingly seeing conversations happening on rebalancing, on diversification, on international allocation. However, 10 to 50 lakh category tends to be on a smaller side. So if you look at the majority of the investors in India, and the young investors, they tend to be, say, below this threshold, and there we're still not seeing this sort of conversation happening with them. we believe that this conversation becomes a lot more important as your portfolio expands, and I think that's where we're seeing these concepts happening. But still, I think it's very early days for this. People are still very much wanting to buy individual mutual funds. There are portfolios out there with not one, not two, but like 15, 20, 25 mutual funds, and all tend to be in equities. People have this, I think, belief that if you're investing in 10 equity mutual funds, you're actually diversified. But actually, no, that's not diversification. It only happens if you are diversified across asset classes. So as an AMC, we would keep talking about multi-asset allocation. It's you should have some of your wealth in equities, some of it in fixed income, some of it in gold, some of it, as you said, in international funds. And when you have all four, or even real estate, all 4 or 5 asset classes together, you are truly diversified, because you're not because these 4 or 5 move pretty much together. So I think that concept of multi-asset diversification is still yet to happen. But as I said, I think people who have larger portfolios tend to, adopt these things faster, because they know that it's now serious money that they have to manage. But yes, it's happening, but happening a lot very slowly.
Pratik, just to understand, do you foresee a time when young investors will rely more on AI or advisory model to manage risk rather than DIY investing? Do you already see that happening?
Yeah, yeah, it's very interesting, because obviously AI-based advisory is sort of taking off, where people are. I think we definitely feel that that as an advisor, AI can do at least the current version of AI is good enough for you to really select the right mutual funds, select your SIPs. Having said that, AI may not help in managing behavior, which we believe is a lot more important. AI is more about a conversation where, I think if you're not able to ask the right questions, then it may not be able to help in the right way. AI doesn't come with experience. Obviously, it does, but we believe that, when it comes to investing, ultimately behavior is either managed by the investor, or obviously by a advisor or a distributor. So yes, a lot of positives happening in the world of AI, and we believe that definitely AI can supplant advisory, or but the behavior aspect is still yet to be seen. And any advances there would actually be meaningful for the DIY investor. In fact, we believe that the DIY that an advisory based approach is actually better than a DIY approach, because what happens is people tend to get very emotional about their investments. People tend to make risky bets. People tend to think very short term, and having a third party out there really helps in managing behavior. We believe that the success of investing is to actually invest for 5, 7, 10 years without really having to do much. And not having to do much is actually quite difficult, especially with so much volatility. And I think if you're able to build AI systems that is able to handle investors towards adopting long-term investing, I think it can be great for investors.
All right, Pratik, last question. How do young investors respond to market downturns? Now, do they hold, panic, sell, or buy the dip? How do you understand their mindset or rationale behind these market moments?
Yeah, so one of the most positive things that we have witnessed in the last at least 10 years is how mature an average investor has become when it comes to market falls. Obviously, people have their views, people invest on their views, but I think people definitely see market falls as temporary, which I think is a very good trend to have. We have not, like, even during the COVID crash, we did not see a lot of panic selling that we saw. In fact, I think people have been overly optimistic, or overly invested during falls. So we've seen a lot of buy on dips happening when the market has had fallen this year as well. There was a lot of flows coming into the markets from our own mutual funds, which show that people actually want to take advantage of market falls. So which is a dual benefit, and which is why bear markets have become a lot more short term than they used to be. If you look at bear, if you so we've done studies on bear markets over the last 4 decades. And the 80s and 90s, an average investor spent about 25-30% of the time in bear markets. Last 20-25 years, it's come down to 1 or 2 years time, even less than that. So I think the markets have become a lot more mature, and people have not resorted to this buying and selling based on market levels. So definitely, I think that's been a very good trend. In fact, even systematic investment plans, SIPs, we haven't really seen a lot of stoppages happening, even during this sort of flat market or slightly bearish market that we've seen over the last 1 year. So people have been very mature, and we hope that this sort of, and this is especially true for younger investors who tend to be a little bit more, I think agile and want to be, so I think we've seen a lot of maturity, and hopefully we'll have this maturity stay, as we move ahead.
All right, on that note, it's time to wrap up this discussion. But thank you so much, Pratik. You've been a voice, the favorite voice of our young investors. And thank you so much for being on the show and helping our young viewers decide or analyze their risk in their investments. Thank you so much.